Hello, everyone. Welcome to a Wall Street for Main Street podcast special. My name is Dawoud, and today's special guest is John Rubino. He is the co-author with Gold Money James Turk of The Collapse of the Dollar and How to Profit from It, and he's also managed a website, dollarcollapse.com. John, thank you for joining us again.
Oh, sure, Mo. Good to talk to you.
Well, I want to first start this discussion by talking about the general stock market. There's a lot of questions out there that the stock market might crash soon. If you look at the technical chart, I don't know if you look at the chart or not, but it's extremely overbought, in any overbought territory. And there's a lot of people like Mark Farber that are predicting a 1987 type crash coming soon. Do you buy into that, or do you believe the market will continue to go up?
Well, I think the Federal Reserve has created a huge number of new dollars, and some of them are flowing into stocks. And as you said, this has been going on for such a long time that we've reached a lot of different technically overbought areas. You know, no matter how you look at it right now, the U.S. stock market looks like it's ready for a correction. You know, leaving the macroeconomic issues out of the picture for a second, just based on the chart, it's had a huge long run, and very seldom does something go on for much more than 3 or 4 years, as this has. You know, usually you get a big, serious correction at the end of a 3 or 4 year run. So we should expect that, irrespective of what else is going on in the world. And there are a lot of other reasons in the world right now to be pessimistic. You know, there are a lot of geopolitical issues out there, and the major economies of the world seem to be slowing down right now. The fundamentals just don't look good. Europe is possibly in a recession. The U.S. had negative GDP growth in the fourth quarter. Japan is just a mess no matter how you look at it. So this isn't the kind of an environment where you would expect equities to have a nice run, other things being equal, because the underlying economies that corporate profits are derived from are not very healthy right now. So a lot of this is an artifact of extremely low interest rates and extremely easy money, but that's not a perpetual motion machine. You can't go on forever with bad things happening in the real world and low interest rates just powering you along. So, yeah, I would expect to see the stock market do less well this year, certainly, than it's done in the past few years.
You know, if we had a free market economy, the stock market would have crashed a long time ago after the 2008 financial crisis, instead of having this continuing uptrend due to 0% interest rate by the Federal Reserve, the federal government stimulus, and etc. What we have today is managed market instead. Don't you agree with that?
Yeah. We had a near-death experience in 2008, and the government ever since has been flooding the system with newly created dollars. And a lot of it is just finding its way onto bank balance sheets, but some of the rest is starting to find its way into the real economy. You know, real estate is starting to pick back up a bit, and corporate profits and cash balances are very high. So there are some effects of easy money that are positive for the stock market. But again, it's not the kind of thing you can do forever. If we could get prosperity by creating lots of new currency, then the whole world would be rich, right? This is not something that you can do in the long run, because the side effects eventually become so horrendous that it negates the short-term sugar rush of easy money. And we'll get there pretty soon. You know, one of the main currencies of the world will start to tank, or interest rates will start to go up because inflation picks up. Something will happen that is a secondary effect of easy money, and that'll short-circuit this process. So anyhow, to long answer to your question of, is this a managed market? Yeah, it's a managed market. They all are now.
Yeah, unfortunately, every sector in the economy it's a managed market. It's a free market economy anymore, except for maybe the technology sector. It has a little bit more free market there compared to other sectors.
Mm-hmm. Yes.
But I agree with you. If you look at the chart, yeah, it's overbought, but I think we'll only see a small correction, and it will continue its uptrend due to the Federal Reserve manipulating the market and how they market and all the other markets you can think of out there.
Yeah, well, until the system hits that wall where the dollar starts to fall or interest rate starts to spike or something like that, and then we will have a monstrous bear market in equities. But that's, well, it feels like it's a ways away. You never know for sure what's going to happen in these incredibly unstable markets. But yeah, it's reasonable to think a correction now that the Fed will respond to with even easier money, which will pump up asset prices again. You know, we can get this kind of a cycle over and over again until the final crack up. And there's no way to know what that's going to be until you have retrospect, you know, until you can see it having happened and know that that was the one.
Right, I think you're referring to a black swan event that need to happen for the market to crash.
Yeah, or a crack up boom from Austrian economics or something like that, where there's so much money flowing into the system that you get massive misallocations of capital and extreme speculation, and the system just kind of has a nervous breakdown. And we came very close to that in 2008. Earlier in the decade, so much money was pumped into the system that the housing bubble could have qualified as a crack-up boom. But we responded with even more credit and more newly created currency, and we bailed ourselves out at the cost of 10 trillion new dollars of debt on the government's balance sheet. So the next time it'll be harder, and if there's a time after that, it'll be even harder. But at some point, this conceptual system runs out of steam and falls apart. And my guess is that we're not very far from that, just based on the numbers. I mean, we owe vastly more than we can ever hope to pay off already, and interest rates are pretty much as low as they can go. So we've pushed a lot of these things beyond the red line, and it wouldn't at all surprise me if sometime in the next few years the system just freaks out from all its imbalances.
I agree, and one of the current event that's going on in this country is the upcoming so-called government austerity in the United States. And there's a lot of investors out there that's wondering what effect that would have on the stock market. What's your opinion of that? Do you think the stock market will be affected if, in fact, this government cut goes into effect?
Well, they're not going to cut spending. I mean, they've built in these automatic cuts, which are catastrophic from the point of view of heavily leveraged financial system and from the point of view of politicians who want to get reelected. So we will not have austerity in the U.S. as long as these guys are drawing breath and have the ability to sign spending bills. So they will find a way around the automatic cuts. They'll come up with a deal that they probably won this time around, that they tout as a grand bargain to reduce the deficit by $2.5 trillion over 10 years, which is a meaningless amount of money, first of all, and will never be put into place, second of all, because a current Congress cannot obligate future Congresses to do anything when it comes to painful spending. So nothing will get done. They'll kick the can down the road. They'll increase the debt limit by another $2 trillion and flood the system with new currency. And this will go on until some crucial component like interest rates or currency value stops it. And so my guess, again, just a guess, but my guess is that they'll cut a deal, the centerpiece of which will be the raising of the debt limit, and then precious metals will respond as they tend to with the raising of each debt limit. You know, gold and silver have pretty much tracked the U.S. debt limit on virtually the same arc up over the past decade. And I would think the same thing would happen. And so, go ahead.
I'm sorry, I was trying to say that there's a lot of rumors out there that in exchange for government cuts that the Republican wants, the president wants to be able to have the power to raise the debt ceiling anytime he wants without asking for Congress approval, which is very, very dangerous.
Yeah, but in effect, he already has it now because Congress isn't going to do anything to derail the easy money program that they know their jobs depend upon. You know, if they stop the debt limit from going up, interfere with our ability to raise new money by issuing treasury bonds and by having the Federal Reserve monetize those bonds, then the economy will grind to a halt and they would get blamed for it. So we do this little shadow dance every couple of years when it's time for the debt limit to be raised, but we always end up raising it. So this just allows people to posture in Washington and pretend to be in favor of limits on government borrowing and smaller government or more rational government or whatever term they like to use that sells with their constituencies. But nobody actually expects the federal government to stop growing or to get smaller. That will not happen. We'll keep on spending more and more money each year and borrowing more and more money each year until the market stops us. So
yeah.
Oh, go ahead.
I'm sorry. Yeah, I just wanted to say that Washington, D.C. is right in my backyard, so I know exactly what you're talking about regarding the politicians want to keep their Ponzi scheme going and keep their cushion job and et cetera. Because, if they can't increase spending, then game's over.
Yeah, it is. And this dates back to taking the dollar off of the gold standard originally and completely breaking the link between the dollar and gold in the 1970s under Richard Nixon. Since that time, Washington has not had to prioritize. We were able to spend anything we wanted on anything we wanted and then just finance the excess with newly created bonds. We could borrow the extra money. And so we've become a society where nobody has to prioritize. We can have a global military empire that's bigger than the next 15 military budgets in the world put together, and we can have a cradle-to-grave entitlement state where you get money from the minute you're born until the day you die from the government. And we can finance it all by borrowing and by having the Federal Reserve create new dollars, because the dollar isn't defined as anything. It's just it was a piece of paper, and now it's just bits in a computer. You can create a trillion new dollars by typing in a trillion and hitting send if you're the Federal Reserve. That's all it takes. And so we as a society have come to see that as normal, and it'll continue to be normal until it's not.
That's a great point. Now, I want to shift gears here and talk about the ongoing currency war that's going around the globe. We have the U.S., we have Japan, we have the U.K., we have Europe, we have Australia, we have South Korea. We have all these countries devaluing their currency so they can stimulate their export market and get their economy going. And there's a lot of experts like Kyle Bass are saying Japan will be the first to go down in the currency war, and they will go down before the U.S. Do you agree with him on that one?
Well, he makes a really compelling case about Japan's debt level being completely unsustainable. Japan had a few unique characteristics that allowed it to borrow as much money as it did. It now has more sovereign debt as a percent of GDP than anybody else, more than Greece, more than France, more than the U.S., and the things that allowed it to do that are going away now. It used to have a population that saved a lot of money and bought all the bonds that the government was putting out, and it used to run a trade surplus, which allowed lots of foreign money to come in and finance its overspending. Well, those two things are done now. The population is aging, and a lot of Japanese are retiring, which means they're dipping into savings rather than buying government bonds with their savings. And the trade surplus has turned into a trade deficit, which means foreign money is no longer flowing in. So Japan now has to finance itself both with internal funds and with money that it's going to borrow overseas, which means it has to pay more or less the same rates that the U.S. and Germany pay, which is maybe 2%, let's say, blended on all their bonds. Now, right now they pay 0.5%. So if their average interest rate, this is Kyle Bass's calculation that I'm repeating here, if their average interest rate goes to 2%, which is not high in the scheme of things at all, their interest costs will exceed their total government tax revenues, which is a total crash and burn scenario. They will implode if that happens. And they're not that far from it happening because their interest rate is necessarily going to have to go up as they start to borrow overseas.
I don't think the Bank of Japan is going to want to raise the interest rate anytime soon, since they have a 2% inflation target that they're trying to achieve. Is that correct?
Yeah, that's another thing. If the federal government is forcing the Bank of Japan to set a 2% inflation target and achieve it. Now, if they do that, and their bonds are yielding 0.5%, who would buy their bonds? Nobody in a foreign country would probably want to do that. When inflation is accelerating, which is to say the value of the currency is falling at an ever greater rate, and the interest rate that you get on bonds denominated in yen is less than half of the inflation rate. It's a losing proposition, and nobody in their right mind would devote a lot of money to that kind of a proposition. So Japan will have a great deal of trouble borrowing at their current interest rate overseas, even other things being equal. But if they have an accelerating inflation rate, it's going to be even harder. So yeah, Japan looks like it's in a box where it may be the first one to implode out of all the big countries that have borrowed too much money. But as for the currency war scenario, it's completely to be expected when you look around at how much everybody has borrowed. When countries get too deeply into debt, their final strategy tends to be lowering the value of their currency in order to pump up their trade. If your currency is cheaper, your exports are cheaper, and your export industries tend to sell more overseas and produce more taxable gains that help the government's balance sheet. And so everybody's trying to achieve the same thing, which is increase trade via a weaker currency. But it's a zero-sum game. You can't all have a weaker currency because it's all relative to each other's currencies that you're measuring these things. So we're seeing kind of a game of musical chairs where one country lowers its currency exchange rate and then reaps some benefits from that, but at the expense of its trading partners, who then retaliate and lower their currencies, and so on. And Jim Rickards, whose book Currency Wars is a must-read for anybody who wants to understand this process, says that this goes on until you get either chaos or currencies that are so low, devaluations across the board, to the point where debt levels are manageable once again. And so getting from here to there means that a lot of money is going to flow into hard assets, which will go up in terms of these depreciating currencies. So that's phenomenal for precious metals. That's in a currency war scenario, gold and silver are the assets of choice.
And speaking of hard asset, real estate, well, it's not really a hard asset, but real estate, if you look at the numbers, it's starting to have another mini bubble going on here because of the 0% interest rate and the low interest rate for the 30-year mortgage. Now, you're great at predicting bubbles in the past. Do you think the housing market is undergoing another mini bubble, not big compared to what we had in 2000, but something a little bit smaller?
Well, in housing in the U.S. right now, inventory just dried up. Nobody wanted to sell at the prices that houses hit after they had 3 solid years of really plunging. And so there aren't very many houses on the market in a lot of places, which is causing prices to go up a bit. And the other thing, like you said, is very low interest rates. So you can get a mortgage now for 3.5% for 30 years, which is crazy. That somebody will lend you money for 3.5% for 30 years is kind of hard to pass up, because that might be the cheapest money that you ever see in your lifetime. But this probably has a limited lifespan, just because it'll be hard to keep interest rates this low forever. And the real estate market is still highly leveraged. So in a lot of places, you'll see a lot of investment money coming in now, and you'll see people buying houses at these prices, but you won't see huge spikes like we saw in the 2006, 2005 range, just because the market is still highly leveraged. We started from a lower base back then, and we had a lot more room to lower interest rates, but we're reaching the point now where we can't lower interest rates anymore. So people who have bought at these rates right here can't refinance, you can't use their houses as ATM machines, and so the market's not going to take on the absolutely manic tenor that it took on earlier in the previous decade. You could still, as long as the economy is not tanking, see real estate be at least not a drag on the economy. It won't be this boom like we saw in 2006, but it might be one of the reasonably healthy parts of the economy until, like I keep coming back to, until some big macro thing like interest rates or the dollar's value throws a wrench into the whole machinery.
Now, I want to shift gears and talk about the precious metals and what's been going on lately. As you know, Germany has asked for their gold back from the Federal Reserve in New York. I'm not sure how much exactly they have in the Federal Reserve. I believe it's 500 tons or somewhere around there. But why do you think they're asking for the gold back now? Do you think they want it as a protection against the current ongoing currency war, or do you think they might go back to the gold standard and go back to their old currency?
Well, that's why they should want it back. But what they're thinking, I really don't have a clue, because you would think they would have been in on the game. So it's not like they're surprised that their gold isn't necessarily safe with the New York Fed. But it could just be that there was public pressure in Germany that couldn't be explained away by the guys at the Bundesbank and in the German federal government, and so they've reacted to it by asking for some of their gold back. They got their gold back from France immediately, but the larger part of what they want back, coming from the U.S., it's going to take them 7 or 8 years to get it back. So my guess is that their strategy was to announce that they're asking for their gold back, but not really expect to get it back for a really long time, and hope that people are satisfied by this and forget about it and remove the pressure on Germany to start accounting correctly for its gold. Because we know the gold has been lent out into the marketplace and that it doesn't all exist in the American vaults like we claim it has. And until it's bought in the open market and brought back, those vaults are going to be emptier than their accounting would indicate that they are. And for that gold to be bought in the open market and brought back would cause a huge spike in the gold price. In other words, we have a massive short position created by central banks leasing their gold into the market, and either they just forget about it and write off the shorts and leave that gold out there, or which means they have to account for it somehow. They have to tell us the truth at some point. If we can ever get an audit through of the Federal Reserve and the other big bank vaults of the central bank world, or they have to accept that gold prices are going to go up dramatically when they go out to buy it. So that's one more thing that makes precious metals interesting, this massive short position, and makes the global financial system a lot more fragile than it seems on the surface, because the admission that central banks don't have nearly as much gold as they claim that they have would be one more piece of the puzzle of a global currency collapse. It would take away one last piece of credibility from the world's fiat currencies, and that might be enough. That might be enough to cause people to realize that these things are just fictitious. They're manipulated fantasies on the part of governments in order to fool us into accepting dramatically higher debts year after year after year, while the guys in charge get nice bonuses and are treated like geniuses by everybody and get to live these great lives and then retire with huge status. And that's really the game that's being played. And at some point it breaks down, and the only question is when.
That's a great point, and I'm interested in seeing the Comex get audited as well.
Oh, yeah, yeah. A Comex Default is another serious black swan that's out there when the big precious metals exchanges can't meet the obligations of all the futures contracts that have been written. When enough people ask for physical delivery instead of cash settlement with their contracts, then we'll see an exchange or two default, which one more black swan.
Yep, that'd be very interesting going down the road. Now, I have one final question, and as you know, the gold and silver market has been consolidating for about 2 years now. As an investor, are you enjoying this consolidation, or do you find it somewhat frustrating sometimes that the prices haven't gone up even after QE3 and QE4 have been rolled out?
No, I'm not liking it at all. Although I kind of have mixed feelings. I mean, I'm still buying more, and it's nice to get gold and silver at cheaper and cheaper prices, but I've got enough now that I'm ready for them to turn around and start really soaring. So it's time. It's time for the consolidation to end. We've built this nice base. A huge number of macroeconomic events have taken place and trends have begun that are all positive for precious metals. So it's just a question of the selling pressure abating a little bit and then some bargain hunters coming in at this bottom and starting to push it up, and then pulling in the momentum guys. And, then the thing will get going again. And there's no way to know when markets make those kinds of transitions, but this one feels like it's close, because this has been one serious, long, grinding consolidation phase. And it's based on just about every macro indicator that you can look at. It's time for them to take off again.
Yeah, and if you compare the paper market for the precious metal to the physical market is indicating for higher and higher prices, because last Friday people were buying like crazy on the big dip that we had. So that should equate to higher prices, which it hasn't happened yet. So if you look at the paper market, which is being just oriented with massive short position, which is keeping up prices at a hold right now, and I give them credit. They've done a great job, but it won't last for long.
No, I don't think so. Like you said, the physical market is extremely tight. I was talking to a gold dealer today who got an order for something like $3 million worth of silver. Okay, which is a big order for silver bullion, but in the current paper money scheme of things, $3 million is a rounding error in most financial instruments. But it took him 8 days to round up enough silver to satisfy his customer's order. And that's how tight it is, that you can't just get $3 million worth of silver with a phone call. It takes you day after day after day of calling around. And that's a sign that this market is, first of all, minuscule compared to the amount of paper that's out there, and second of all, in extreme restriction right now. It's extremely tight. So it won't take much for a market that tight to pop by 20 or 30% very easily.
I agree. I'm seeing the same thing in the physical market, and I predicted that the first quarter would be a flat quarter for gold and silver, and that they'll pick up in the second quarter. So hopefully that'll happen, and we'll see.
Yeah.
But John, I'd like to thank you for taking your time to come on for a podcast. If people want to find out more about what you do, where can they go?
I run dollarcollapse.com, which is a site kind of like yours, only not as slick. that covers a lot of the things you and I talked about on a continuously updated basis.
Yeah, and a great website, and I urge listeners to check it out, dollarcollapse.com. All right, John, well, hopefully you can come back again for another interview. It's been great.
I'd like that, Mo. Thank you.
Thank you.